Hello, everyone, and welcome. Thank you for joining us. This is Jason Ulrich with Top Shelf Traders. We've got a good-sized group that's joined us, and as folks are filtering in, we'll just do a quick sound and visual check. If you can let us know that you can hear me okay and that you can see the screen okay, that's great. Just put it in the questions box there. If you're having any difficulty whatsoever, please let us know. We'll give it a minute or two here. Perfect. Thank you. We'll give it a minute or two here. We know it's just over the noon hour here on the East Coast, and we'll go ahead and dive in. This is the Top Shelf Traders free training weekly event. Today we're going to be focusing on Elliott Wave analysis and specifically creating a roadmap with Elliott Wave. And we are thrilled to have Bennett McDowell join us. We also have his wife with us as well, Jean. And when we got the opportunity to have Bennett join us, we absolutely jumped at it. We were very excited. If his name sounds familiar, that's for good reason, because he's done quite a bit. He's a published author. He's been trading for 20 years. He presents every Wednesday morning on the TradeStation Morning Market Brief. And he also has a book, The Elliott Wave Techniques Simplified. It's published by McGraw-Hill. So this is an interactive session. Again, with these sessions, our goal is to keep them as informal as possible. If you have any questions whatsoever, please let us know. We'll do our best to answer them as they come through. Gene will be responding actively to questions that come up. And by all means, we'll be following up with a recording of the event so that you can refer to that later. And there's a special offer at the very end, which I would keep an eye out for as well. So with that in mind, Bennett, we're thrilled to have you on board, and thank you for presenting today. I'll go ahead and turn it over to you.
Jason, thanks so much. It's really great to be here, and I want to welcome everybody to today's webinar. Today we're going to talk about the Elliott Wave and how it really is the roadmap of the markets. We use it a lot here at traderscoach.com. In fact, we use it every day on all sorts of time frames, from the S&P E-mini 2-minute time frame all the way up to long-term weekly and monthly charts on the Dow and all sorts of stocks, Forex, etc. So we're going to cover all the basics on the Elliott Wave. We're going to try to take some of the subjectivity out of the Elliott Wave that may have been causing some of you trouble in trying to use it. So we'll cover a lot of bases here. And as Jason said, please ask questions. I may not answer them right away, but I will see them and I will get to them at some point during the presentation. So I can assure you of that. One thing I do want to ask everybody out there is how many people right now are using the Elliott Wave? How many are using the Elliott Wave in their trading right now? Go ahead and answer in the questions area if you could. Excellent. Okay, some attempting, that's okay. No problem, Dojo. All right. All right, good. So we have some people using it and some not. And that's really good, because I think if you're using it, you'll probably learn some things today that's going to help you use it better. And if you're not using it, I think after today you're going to want to try to start using it. So let's go ahead and get going here. The first thing I do have to cover is a presentation disclaimer. You know, they require us to do that and tell you all about the risks involved in trading. I think everybody knows that by now, but of course, you know what I always say, if you don't have the risk, there's no opportunity. So the two really go hand in hand. But just realize that there is risk in trading. Protect yourself by using risk capital and, of course, a good solid system with stops and so forth. And again, I want to invite everybody. Jason did a great introduction for me, and I thank you, Jason, for that. But I also want to invite everybody to our website at traderscoach.com. We have a lot of free information there and a lot of videos to help you learn more about trading the market, so you might want to drop over and check us out. I've also written 4 books. One's called The Trader's Money Management System, and I don't care if you're trading stocks, futures, Forex, bonds, you need to be using risk control at all times. I think everybody can certainly agree to that. And if you are having trouble implementing a good solid risk control program into your trading, get that book, because the purpose of that book is to make it easy for active traders to get going with risk control. The Art of Trading is about our primary trading system. We're not going to really cover this today, but it's called Applied Reality Trading. That's out. We have the Survival Guide for Traders that talks about how to run your trading business from your home with today's technologies, just like advanced hedge funds. And then finally, my latest book by McGraw-Hill is on Elliott Wave Technique Simplified. And this webinar today is going to be breaking down some parts of that book to get you kind of interested in the Elliott Wave. And if you want to learn more about it, you can always purchase the book as well. So these are all available at Barnes & Noble and Amazon. It's kind of fun to go to Amazon and read all the remarks. Now, we also wanted to give you, since you took the time to being here, a free what we call Elliott Wave cheat sheet. And this gives you a lot of stats that you can have right at your fingertips on your desktop. So click on that link there. I put it in the chat area. Click on it, fill out the form. Do that right now before the presentation ends to make sure you get that. But we're going to give you definitions of the 5 Elliott Wave characteristics that we're going to cover today. We're going to give you in this cheat sheet illustrations of what the patterns look like so you have a good idea visually of what to do. Tables with precise Fibonacci target zones for all 5 waves. And it's basically Elliott Wave rules are clearly identified too. So it's a great little cheat sheet. You can download it, PDF form, you print it out and have it right on your desktop as you start tackling the Elliott Wave. Before we get into actually price patterns though, I do want to get into a little bit of the history so you understand how the Elliott Wave really came about and who was behind it. And of course, we have to start with Ralph Nelson Elliott to begin with. He was born way back in 1871. He was originally an accountant. He almost died in 1929, and while he was recuperating from his situation, he was pretty sick, he actually started looking into the financial markets at that time, and he studied the stock market specifically in the Dow theory in 1932 and came out with the Elliott Wave principle, or the Wave principle, in the year of 1938, which was a publication, and then had some final work called Nature's Law, which takes into account the naturalness of the ebb and flow that we see in nature and how it evolves into the Elliott Wave for the markets in 1946, and then he died in 1948. One thing I will say that's interesting about what he did back then is that he basically studied many charts on the markets, and what he found through observational study is that trends, both up and down, bullish and bearish trends, moved in 5-wave patterns. And this was observation. This was not, they didn't have financial computers like they have now that can crunch all the numbers. He had to visually go through the charts. And so we call this observational statistics. So a lot of people will say, well, why does the Elliott Wave work? And quite honestly, it's based on human behavior. And this human behavior, of course, we all work in these ebbs of flows. We have good times, bad times, good times, bad times. And so that is reflected in patterns in the markets. And so that's what the Elliott Wave is all about. Another way to look at observational statistics that I think is helpful in understanding the Elliott Wave is think of, for example, astronomy. They look at things like black holes and so forth, and they observe these things. And matter gets close to the black hole and gets sucked in. So they know when matter gets a certain distance, okay, it gets pulled into these black holes. But you know what? They don't know why. They don't know where it goes. Maybe they will in the future, but they don't know now. But they can certainly come up with a set of rules that say when matter gets a certain distance from the black hole, it gets sucked into it. And that's about all they know. And that's kind of like what he was doing, Ralph Nelson Elliott, back when he discovered the Elliott Wave, is he was looking at all these instances where the market worked in these ebbs and flows or waves, but really didn't know exactly what was causing this. And so I think that's kind of important to realize when you're thinking about the Elliott Wave, and for those of you that want answers as to why it works, sometimes we don't know. And sometimes it's better to just go with what statistically is proven in terms of the fact that these are showing up in markets on all time frames and all degrees. So I kind of think that helps put it in perspective. Now, the next question you may have is, why use Elliott Wave? Well, we use it to forecast price movement for profit. It does encompass, we have found that it encompasses mass psychology and allows us to put it into a form of technical analysis. So when you think of the Elliott Wave, we want you to think of it as technical analysis. It's not fundamental analysis. And also, too, you've heard of market cycles. You know, you'll hear of a market cycle reaching a top and reversing. And the Elliott Wave helps us know what market cycle you are in. It establishes or helps establish price target zones, and for that we use fib extensions and retracements, and we'll cover that in this webinar too. And we use those on certain wave patterns in order to arrive at the right price target zones. And from there, of course, when we use the Elliott Wave and we know our target zones and we know the wave counts, we can, of course, calculate our reward risk expectations. So that's really important. So this is why we call it the roadmap of the markets, because it tells us exactly where we are in the market cycle of the market that we want to trade. And I think that is something you have to know in order to make money in the markets. So just to recap, Elliott Wave principle is a form of technical analysis that investors use, or active traders, to forecast trends in the financial markets and other collective activities. The Wave principle states that collective investor psychology, known as crowd psychology, moves from optimism to pessimism and back again. That's what creates those cycles. And these swings create patterns as evidenced in price movement of a market at every degree of a trend. Elliott's model says that market prices alternate between 5 waves and 3 waves at all degrees of a trend. And so let's take a look at an actual chart. This happens to be Apple stock a while back. And this has a bunch of numbers on it, and those numbers represent the Elliott Wave. So let's take a look at this. First, we got large numbers, and I'm going to circle these. These are 1, 2, 3, 4, and 5. Now, this is actually from Apple stock a while back, and we use this in our trading. And what we noticed is at the bottom of this trend that markets moved up to a 1 and then pulled back to a 2, 3, 4, and 5. So right there you can see that that trend took 5 waves to get to the top, and then after it was over you can see where it sold off. But you can see some other things in this chart as well. Notice we got these smaller numbers like here, 1, 2, 3, 4, 5. So, and then we have down here in wave 2 what we call an ABC pattern. And then when it goes back into the larger wave 3, you'll note we have a 1, 2, 3, 4, 5. Again, from 3 to 4, which is a corrective wave, ABC. And then the reoccurring wave 5, which goes in the direction of the trend, is a 1, 2, 3, 4, 5 again. So from observational statistics here, you'll notice that all the waves that go in direction of the trend are waves 1, 3, and 5. And it's interesting because we call those impulsive waves. Those are called impulsive waves. Waves 2 and 4, which move from 3 to 4, for example, or 1 to 2, these are corrections. These are corrective waves. So you have impulsive waves and corrective waves. Now, due to the fact of fractal symmetry in the market, there are waves inside waves. That was another thing that Elliott noticed when he did his observation of markets. And so in the impulsive waves, there's 5 waves inside them, and we have labeled these 5 waves on this chart as the smaller numbers. And on the corrective waves, they usually come in an ABC pattern. So impulsive waves have 5 waves in them, and the corrective waves have an ABC pattern. And so it's kind of like when you're looking at a snowflake, you can look at a snowflake, but when you put that snowflake under the microscope, you see the crystalline structure of the underlying structure of that snowflake. And that's what we're doing when we count the waves inside the primary waves. We're kind of putting it under a microscope. Sometimes you need to go to a lower time frame to see these waves, but they are indeed there. Okay? Now, this is a good question from Al. What determines where you start counting the waves from? Is it arbitrary? Not at all, okay? Nothing is arbitrary, because as soon as it becomes arbitrary, it becomes of no use to us as traders, right? So what we do is we look for markets that have either gotten to a previous wave 5, then we know it's going to change direction. So we know we can get right in and start a new count from that change. Maybe we've had a channeling market. We're going to look at some of these out. We may have had a channeling market where the market breaks out of the channel, and that channel will represent what I call the 0 point or starting point of a new trend up or down, okay? So there you have it. Now, another interesting point with the Elliott wave, and I'm gonna show you a chart back in the year 2000 when we had the dot-com bubble, and explain a little bit more. But that's going to answer, George, your question about fundamentals and the implications of fundamentals on the wave count. So I'm going to hold off on that just a little bit until we get to that chart, because that will give you a really excellent explanation. Okay, so let's move on here a little further. Okay, and one of the things with Elliott wave that's a little different now than when Ralph Nelson first started doing it is the advent of computers and how that can help us identify the momentum in the waves, you know, as well as the volume, but volume was always able to be identified, but the momentum and some other things that we like to look at that really help us confirm or increase the accuracy of the wave count. And so we call Elliott's rules and observations as classic Elliott wave theory. And we call now what we use today, in addition to the classic, the modern Elliott wave theory. So when you think of modern, I want you to think about the fact that now we have computers that can look at things that Elliott could not look at when he was first doing this back in the 1930s and 40s, okay? So we want to kind of take a look at this and see. But I also want to go just review for a moment some of the classical things that, for example, that Elliott really founded back in the 1930s and 40s, and it focused on price structure, not indicators at this point, but price structure. So if we take a look at this, you're going to see, for example, 3 charts: a monthly chart, a yearly chart, and a 5-year chart. Now, just like in the Apple stock we just looked at, you'll notice that there are waves, 1, 2, 3, 4, 5, that make up this big number 1. And then it goes into a number 2, and we have an ABC correction, just like I showed you on the Apple stock, right? Well then, you know, in this example, that's a monthly chart, not a daily chart. But in this example, we go out to a year, and now we take a look and see how the 1 that was a big deal on the monthly chart is kind of just a smaller wave inside even a larger wave on the monthly chart. See, this 1 now represents just a small 1 on a major 1 on a yearly chart. Then if we go to the 5-year chart, we're going to see that this 1 was now a minor 1 inside a larger wave 3 on a 5-year chart. So basically what this is saying is that there are waves inside waves on all time frames. This is not to confuse you, but this is just to explain that fact that there are waves inside waves. And so when you go to different time frames, you'll see waves represented that may be inside waves of higher time frames. So I think that's important to understand. And here's just a more closer example of a 5-wave pattern with those waves in it, very similar to what I showed you as well on Apple. All right, so let's continue on here. And here is another example of that. I just want you to be able to see all this distinction of the differences between corrections and impulsive waves. So let me ask a question. I want to see how well everybody's paying attention out there. And whether it's an uptrend or a downtrend, what are the impulsive waves? What are the impulsive waves? Okay, I see some correct answers coming in. Try everybody to answer. Okay, excellent. Pretty much everybody's got it, okay? So waves 1, 3, and 5 are the impulsive waves, and there are 5 waves always in the impulsive waves. Now, one thing I didn't talk about that I'm going to bring up now is we're going to take a look at the corrective waves over here a little more closely. And so I think it's important to realize when we look at this that guess what? We have an A wave, a B wave, and a C wave in a correction. So again, take this box and look, it's representing wave 4 and wave 2. But also too, okay, you have a slight, when you have a correction, you have a movement in the direction of the correction. And that movement is waves A and C. Okay, so A and C. So they are also considered impulsive waves in corrective waves 2 and 4. So I don't want to lose anybody and confuse them, but think of it this way. Whatever direction the correction is going in, waves A and C are going to be the ones going in that direction, whereas wave B is just a minor blip up during that correction. So there are 5 waves in A and 5 waves in C, and then because B wave is the correction in the correction, it's only an A, B, C. Okay? So again, I think the purpose of this is just to let you know that there is structure even in the corrections. I don't expect you to be an expert at it at this time, but once you ponder this a little bit and get familiar with impulsive waves and corrective waves, this kind of stuff will sink in, the light bulb will go on, and it will make total sense. So that's why I'm gonna go over it with you right now and just introduce you to these concepts. And so we have bullish and bearish corrections. This is what they call a simple ABC zigzag correction. You've seen that now. And those are little waves that you can see in A, B, and C, or the waves inside the waves. But there's other types of corrections too. This is your standard, most of the time occurring ABC zigzag correction. So waves 2 and 4 will look like this most of the time. But in the markets, okay, there is a certain percentage of times where these type of things look a little different. And so this brings us to the triangular complex correction. Now, how many people have seen pennants in the market? How many people have seen pennants? You know what a pennant is? If you don't know what a pennant is, please just feel free to ask, okay? I think everybody kind of is, or a flag, okay, sure. Flag's a little different than a pennant, but same idea. Okay, good. So most people have certainly seen a pennant, okay? And you see them all the time, as Elton says. Yeah. Well, they form in corrective waves. They usually form in waves 2 or 4. And they're usually looking something like this with a bearish outcome. And then they look, whoops, my little pointer got out offhand there. And then they look, whoops, all right, and then they look like this, okay, with a bullish outcome. And so that's why pennants, whenever they're broken, either the support or the resistance line of the pennant are broken, the movement in that direction is swift because of the fact that it's now coming out of the correction and going into a major impulsive wave, whether it's 3 or 5. So that's why every time you hear, you know, wait for the pennant to break and then go in that direction, all right, that's why. All right, so hopefully that will kind of, you know, clear up a little bit of some forms of technical analysis, wondering why things move in such a brisk direction at certain times. And this is what they call a flat complex correction that you can see, and it basically looks like a channel, okay? So it's not always looking like a pennant, but it can look like a channel. But again, when it breaks that channel, it usually moves. And these are just different types of corrections as well, all right? All right, now, for those of you that have heard about the Elliott Wave, of course, or maybe even tried to use it yourself, one of the major criticisms of the Elliott Wave is that many feel it is subjective, meaning that when you look at a chart, it's easy to see it after the fact, harder to see it as the market is unfolding in real time. So that's one of the things we want to tackle in order for you to be confident in using the Elliott Wave. So again, this is what our goal is, to take the subjectivity out of Elliott Wave counting. So how do we do that? Well, we introduce a couple of confirmation tools which we put under the modern approach, which we use basically in terms of certain indicators that help us more accurately count the waves. So let's take a look at those and see. One of the things that I like to do is connect the dots using multiple different types of technical analysis tools. And I also do it by combining the classical and the modern approach, thus increasing your odds of success. My approach combines several key studies and components, which significantly increases the probabilities of accurately counting Elliott waves. These key components are as follows. We use all the tools of the classical approach, which, just like the cheat sheet I gave you today, if you downloaded that and looked at it, you can see it has a lot of statistics on, wave 2 should never go under the beginning of wave 1, things like that, statistics, retracement statistics. So we use all those classical approach numbers. We also use Fibonacci levels for retracements. In other words, we have a certain probability that a target level, for example, for wave 4, goes between 38.2 and 68.1%, 70% of the time. Okay, so that's pretty good. All right, we use certain histogram settings to confirm Elliott wave counts that basically take into account momentum. We have some other things that we use on some other indicators that we put down in the charts, and I'll show you those in a minute. We look at the fractal nature of the Elliott wave. In other words, every wave needs to end on some type of pivot point. Volume, we have the highest volume in Elliott wave 3, and Elliott wave 5 always has lower volume and less enthusiasm than Elliott wave 3. So Elliott wave 3 is the most powerful in the 5-wave trend. Price compression, we look for channels, pennants during waves 2 and 4 for opportunities. And if we see a pennant forming, we know it's in a corrective area. I also created what they call a probability matrix, which I go into great detail in my book. And this assigns a percentage to the Elliott wave forecast. So we take into consideration these items here and then actually apply a number to them in terms of accuracy, how good they're looking, how clear the wave count looks to you. And you assign a percentage to that adds to the probability of that wave count being correct. All right, and then of course you cannot do anything without risk control in the markets. And with the Elliott wave and connecting the dots, we take a look at grounded versus ungrounded assessments and weigh their value. So we'll get into that a little bit too. So we have found by combining both the modern approach and the classical approach using computers today, all right, and connect the dots, you go a great deal, a long way in taking the subjectivity out of the Elliott wave count. Now the next question that leads us to is the million-dollar question of, now that we can take the subjectivity out, does the Elliott wave work? Well, let's take a look here. Okay, again, when we look at things, we want to look at clear price structure. We want to look at volume, Fibonacci, all the things we talked about before, so we can look at a chart like this and start to make some sense out of it. Now again, this is an Apple chart back when it topped a couple years back on wave 5. And notice here a couple things. Oh, my little pointer's all over the place. All right, let me try another pointer here. Let me just start here and say that forget these triangles. This is all part of our art trading system, so you don't need to know that right now, but these charts were printed with that on there. But some of the things that we look at is, for example, during a wave 3, which is here, okay, wave 2 usually has what we call a bearish, and this is what we call an owl histogram that measures momentum. And what we look at is for the highest momentum and volume to be on wave 3. That has to occur. And then we look also to make sure, we also use something else down here called a PTF indicator, and you can go to our website to look at more of how these work. But we don't want to see any red in this indicator down here at all when we are in a wave 3. So this is considered the modern approach by adding these indicators to the price structure approach, which tends to be a classical form of the Elliott wave, which Ralph Nelson Elliott discovered. So during wave 3, the indicators have to confirm what the price is telling us. During a wave 4, you have to have negative momentum. If the momentum does not go negative, you do not have a major wave 4. And then when you have wave 5, all right, then you must have divergence between the top of the momentum indicator 3 and the top of the momentum indicator 5. And if you think about what's going on here from a practical standpoint to try to make some sense of this, what you want to do here is actually take a look and see what we're thinking. So during this trend up, everybody's getting into it, right? The entire herd is getting into the move. They may not get into it down here, but by the time this momentum is peaking, there it is. And notice, guess what? Momentum is always highest just before the particular wave ends, doesn't it? See that? Boom, and then it ends. So most of the herd is wrong. They get in here, and then they get stopped out. But if you can start looking at wave counts to get in early, then you're much better off. And that's why when you see price compression and then channels get broken out here after a change, that's when you want to get into it. We have a whole course on our website for Elliott Wave traders on how to do that with specific rules for price patterns that we look at to get us in early on trends. So once you have wave 3, you have the entire herd. Well, the volume's going to be highest. That certainly makes sense, right? Volume is going to be highest here, as is momentum. And then once it gets to a certain point, then we see a sell-off. And notice here on this sell-off, this is a wave 4, and you can clearly see an A, B, C correction. So this would be A, this little point up here would be B, so more like that, okay? And then down here. Notice I have a bunch of fib lines drawn here because wave 4 has to hit the high probability target zone. 70% of the time they go here, okay? 15% of the time they're a little shallow between 23% and 38 and 15% they get extended. But most of the time they end here, and that's exactly what happened there. And then we look for trades again when the momentum goes bullish to continue up to the target zone for wave 5. Now, how did we get this target zone? We use fib extensions and anchor the extensions on wave 2 back here. 3, we anchor them on 2, 3, and 4. And that's how we get the fib extension target zone. So once prices get in here, we start moving our stops closer, and then when the momentum changes, like it did down here in the owl, then we can say the trend is over, it's time for a trend in the opposite direction after wave 5, and that's exactly what occurred. So then you can start going short. So if we also back up here and think about knowing where we are in a market cycle, once you identify wave 3, which is actually really easy to do, because wave 3 is going to have the highest volume. It's also going to have the highest momentum. So it's actually pretty easy to identify. It's also going to have the steepest slope as well in prices, because prices tend to move up fastest. Okay, it has the most momentum during that period of time. Momentum, basically, when you think about momentum, think about how fast price is moving over time. All right, it's not necessarily a function of volume. It's how fast prices are moving over time. But you can also use volume because Elliott Wave 3 has the highest volume. So there you have that. Now, when you start out here on Elliott Wave 5, you can certainly see that the momentum never got anywhere near as great as 3. So you know that's a 5. And from that point where after you've had your ABC correction, it's very easy to figure out what your Wave 5 target zone should be. Okay? This should excite you because this stuff here, right here, is giving you the roadmap to the market that you're trading, any market you're trading. So again, key, find wave 3, and the rest is easy. And if you miss wave 3, you know, there's also an opportunity where you could trade the wave 4, and then after 4, you can trade wave 5, and guess what? Then after wave 5, you can catch the brand new next wave 3 going in the opposite direction. So once you find wave 3, the rest is easy. All right, so keep that in mind. All right, let's move on here a little bit more. Here's one on a short trade here. Notice the short trade I've got set up here. And notice that here, all right, this is a 2, 3, 4. There's your anchor points to get the wave 5 target zone. And notice here, there's wave 5, here's wave 3, and there's your bullish wave 4 indicator, so it's still heading down into that target zone. Now that's an S&P E-mini chart on an intraday time frame. So when I'm asked, does this work on intraday time frames, remember this chart, okay? All right, let's move on. Here's one on a stock chart, same type of analysis. All right, in other words, you got wave 3 is the biggest OWL momentum indicator. You have wave 4 negative, check. All right, notice that we have no red here on the PTF during this entire bullish move. Notice wave 4 came down to the target zone, and there you go, right into the wave 5 target zone. So once you've identified wave 3, wave 5 target zone, easy as pie to identify. All right, here it is on a bearish trend. This is probably a fairly one that's not quite as clear as the others, but again, you know, here's your short position here. You've got the biggest OWL down here. This is 3, pardon my handwriting here, 3. This is 4 and 5 coming to an end, not quite over yet, simply because the PTF is still red, so it looks like it's probably going to go down one more time. But in this case here, all right, you have bullish divergence between wave 5 and wave 3, okay, with the Elliott Wave count as such. So pretty exciting stuff that works on both uptrends and downtrends. All right, now here's one, and this goes back to George's question that I told him I would answer at a later point, so I'm going to answer this now. So in this question here, what's interesting is that this goes back really to 1992, and how many people out there were trading during the 90s? Let's see how many older folks we got out there. Okay, Elton's one. Okay, good, quite a few. Okay, so if you remember, for those of you back then, and for those of you that aren't, this will be kind of fun to hear. If you went to a cocktail party in the late 1990s, what were they talking about? Day trading, stocks. You could not go to a party, I'm telling you, without hearing somebody talk about a stock, and most of the time it was a tech stock. I mean, it was just exploding back then. And that is so characteristic of a wave 3 in that what creates a wave 3 is basically everybody and their mother, okay, in the markets creating that trend, especially if it's a bullish one, up, right? So this is what the 1990s looked like, and towards the late 1990s, it was really euphoric. And if you remember back then, all the news was coming on saying the markets are new this time. This is not like the old markets. This will never end. And of course, as soon as you hear that, all right, you want to run for the hills. But in any case, this was also the dot-coms were coming online here. But what was interesting is at that time, and I was managing quite a bit of money at that time, and I was doing my Elliott Wave analysis, and I could clearly see this was a wave 3. And with some of the other modern approach indicators, things were looking like the party was getting close to being over. So I came out with a forecast saying the market would go down to about 74 to 7,500, maybe 7,000 if it got extended within the next few years. And I got to tell you, when you come out with a forecast like that, when everybody is in this area of a wave 3, they are going to think you are nuts. And that's exactly what the emails I got, especially from many of my clients. But lo and behold, all right, guess what? That's exactly what did happen. And if you remember, there's quite a few fundamental events that occurred that made that happen. So first thing is that we had a break in the dot-com industry. You know, everything is called the dot-com bubble. But we also had 9/11, all right? And 9/11 caused this market to really move down into those single digits. Now, when I forecasted that, I had no way of knowing what fundamentals or world events would occur to make that happen. But that would be a normal retracement for a wave 4 down to the 7,500 level on the Dow. And that's exactly what happened. And then after that, we had a wave 5 and the markets got back on track. So in this case here, this is a great example of how the Elliott Wave works on the ebb and flows of human behavior and can take into account events that can cause markets to change. Now, another important thing for this to make sense to you is you have to realize during a bull market, during waves, impulsive waves 1, 3, and 5, you will find that the markets ignore bad news. And during the corrective waves or during a downtrend, they will accentuate the bad news. Okay, so that's an important thing to realize. Notice that, you know, with all the turmoil that we have had lately in the world, you have North Korea, you have all these hurricanes, the market is making new highs because it's in an impulsive wave right now. It's ignoring the bad news. So that's an interesting fact because it shows you that when human behavior as crowd psychology changes to pessimism, we focus on the bad events and ignore the good events. When we're in an impulsive wave focusing on optimism, we focus on or accentuate the good events and not the bad events. And I think that's exactly what the Elliott Wave takes into account in terms of sorting through world events and economic events as they're unfolding. All right, so as we get towards the end of the presentation here, I want to make sure everybody has had a chance to download this particular cheat sheet. So I'm going to put it up there again in case you didn't see it, just so you have it fresh. So download this. It's a cheat sheet that's going to give you a lot of support in understanding how all this works. And also, too, let me just get to some questions here. All right. Here's a good question from Trevor. How do you distinguish between a minor impulsive wave and a major impulsive wave? You can go to the higher time frame, Trevor, on the chart. Let's say you're looking at the daily chart. You can go to a weekly chart and see if that daily chart is a minor inside a major. Also, too, you're going to have to pick a time frame that you want to focus on as your I'm going to say, prominent time frame, because that's where your risk control is going to be handled. So even if you're trading, let's say, a daily chart, and you're trading a wave 3, which may be inside a wave 5 on a weekly chart, you're still going to trade the wave 3 on the daily. Okay, all your risk control is going to be set up with that. All right, let's keep going here. Let me just, oh, you're welcome for the cheat sheet. No problem. All right, I'm just going through the questions. Okay, hold on one second. Okay, I answered that one. I think I answered that one. Okay, so how does this help with intraday or for swing trading? Well, hopefully, if you stayed the whole time, you get the fact that the Elliott Wave really is a roadmap of the markets. So when it is a roadmap of the markets, then you're going to know where you are in that market cycle, so that's going to tell you whether you should be taking long trades or short trades. And then once you have identified wave 3, okay, then also if you want to trade beyond that, you can create target zones for the end of the trend. All right, so it all falls together. Good question, though. Okay, your numbers come after the wave has finished. Well, surely if you come to my live trading sessions, you'll see that that's not the case, that I will tell you where we are and where we should be going. So it just depends on, you know, where we're showing up in the market. For example, when I do the TradeStation morning briefs, I have all the guys give me stocks and we just go through them, and I give them a quick Elliott Wave analysis and tell them where I think the target zones are based on the current market at the current time. A lot of these slides that I have here are for educational purposes, so we want to show you, you know, how wave 5s end based on target zones and so forth, okay? All right, good questions. Hold on, more coming in. Okay, so here's a good question. If wave 5 has exceeded the high of wave 3, but when we don't use an MACD, we use something else, a little more proprietary. All right, still hasn't crossed over the 0 in the histogram. Does that mean wave 5 still has a long way upward to go? Well, it depends on what you use. This is why we use a proprietary indicator, which, by the way, you can get from us if you want on our website, called the OWL. We've tweaked it so it's very sensitive to the Elliott wave. So in other words, when it goes to the green side, you are in a wave 5, but not only that, it goes to the green side early enough so you can actually enter the trade in time to make money on that. So wave 4 on a bullish trend has to be negative, wave 5 has to be positive, but wave 5 histogram cannot be higher than wave 3 histogram on the oscillator we're using, okay? All right, let's see. You can do it on a 1 minute time frame because remember, there's waves with inside waves, okay? That a wave 3 on a 1 minute time frame may be a very small, may be part of a very small movement on the daily chart, okay, obviously. If you're using a 1 minute time frame, this is the example. If 1 minute time frame is your primary time frame, you don't need really in terms of trading to go any higher than a 5 minute time frame or a 10-minute time frame, okay, in terms of looking at the higher degree of an Elliott wave count where you're going to make money, okay? You don't, if you're trading a 1 minute, don't look at a daily or a weekly, okay? It's too far out, all right? Just go up about 5 time frames. Yep, support and resistance can indicate turns in the market and good areas to catch the next wave. Sal, that's true. What is my trading platform? I use a variety of different ones. TradeStation I use, NinjaTrader, MetaTrader 10 we use, eSignal, things like that. Yeah, MetaTrader 4 and 5 and multi-charts too. I think, Mike, this will be recorded, so I think you're all set there. All right, well, I think that pretty much does all the questions. So what I'm hopeful I did today was really open your eyes, okay? You need sometimes a little bit more time to go over all the little details, but that's what we have a home study course for, and that's what we have the book for. So if this, you know, interests you, which I sure hope it does, because I've been using this for over 20 years now, and it has made a huge difference in my trading. It will give you confidence of where you are and where the market's going. So I really suggest that you delve into it, look into it more, and stay with it because it's just such a great approach. So again, if you want to learn more about how do we connect the dots and what kind of indicators we use and the settings on the indicators, definitely check out the book and our home study course and you'll be in good shape, okay? Let's just keep going on here. I guess that's it, okay? So let me just see if there's any last minute questions. And Paul, yes, the OWL works on the Forex charts with MetaTrader 4 and 5. How far can we predict wave 3 to go? Excellent question, Tom. What we do, if we have a wave 3 on a daily chart, what we do is usually go down to the 60-minute chart and look at the minor waves inside the wave 3 and then use fib extensions on 3, 4, and 5 on the 60-minute to give us the top of the wave 3 on the daily, if that makes sense. So every time you have waves inside waves, you can go to the inside waves to look for the top of a major wave. Wow, good questions. You guys are excellent. How do you accurately identify a pivot point? We have something called the ART trading software that has reversals that help us do that, reversal calculations. Okay, good. MT4. All right, Shirley's saying for some reason, I think Jean answered you that you were having trouble downloading the cheat sheet, so she'll send that to you via email. Could probably your browser won't allow it or something, who knows. All right, well, that brings us to the end. We tried to finish up within an hour, and I think we did a pretty good job on that. So I want to thank everybody for attending. Really excellent questions. I can always tell how good a group is by their questions. And Jason, you got a good group out there. So I want to thank everybody for attending. Please stop by, visit us at our website, or you can contact us. There's our contact information. So everybody, have a great week. Think about the Elliott Wave. Try to incorporate it into your trading. I guarantee you'll love it, okay? So Jason, back to you.
Thank you very much, Bennett. That was fantastic. And To our crowd that joined us here today, we really appreciate it. The questions were great. Well, those of you that we may have not gotten to for whatever reason, we will go back through the questions log. We'll make sure that we follow up where needed. And then, of course, yes, we have this recorded. We will go ahead, get that published, and sent out to you via email. Keep an eye out for the next free training session. Those come out via email notices. These are free events. They're designed to be practical and tactical, and they will all hopefully live up to what Bennett did here today with us. So Bennett and Jean, thank you very, very much. It was great having you. The content was amazing, and for those of you that we need to follow up with, we'll be sure to do that. Okay? All right. We're going to go ahead and close out here with about 9 minutes to spare. If you have any questions whatsoever that we don't get to, or you think of something later, please email us. You can reach us at info@topshelftraders.com. Again, info@topshelftraders.com. We'll follow up. And thanks again. We really appreciate it. Have a great rest of the day, and good luck trading.